Hey guys, and welcome to Road to Forex, where we discuss everything in relation to the foreign exchange. Of course, I am your host Alex, so without further ado, let's get stuck into today's episode. Now today I am going to be going over something that is very popular within the Forex world. Majority of you will have seen something about it, and I dare say at least 50, if not 40%, of you will have traded something like this strategy that I'm going to be talking about. Of course, it is ICT trading. Now again, it's not something that I'm completely familiar with, but unfortunately being within the Forex world, and I do feel like I say this on a lot of my podcasts, really good at drawing people in terms of scammers. Even when I started my Instagram page, the amount of ICT symbols that I would see, ICT trading, they're just everywhere. So I think it gives Forex a bad name. That doesn't mean the theory behind it is bad, but let's go into it today, see if we can avoid all that trash that is pushed out there by people that, can't really trade, and get into the crux of ICT trading. What is it? What are the pros and cons? How can we use it as traders to our advantage? And is it even worth it? Are there better things out there? So, first of all, for those of you that don't know, ICT trading stands for impulse, correction, and trend. It is a popular trading strategy, as I said, which is used in the Forex markets that involve identifying and trading 3 different stages of price movements. Now, going into this, we'll talk about the first stage, which is that impulse stage that I originally talked about. So this is where price moves rapidly in a single direction, right? And the second stage would then be the correction stage, where price retraces or consolidates before potentially moving in the same direction as the impulse stage. Very important there, same direction as the impulse stage. And then finally, we have the trend stage, where price continues to move, as I said, in the same direction as that impulse stage there. So the ICT trading strategy involves identifying these 3 stages and placing trades accordingly. For example, right, if during the impulse stage, you and me as a trader, we might enter a long position in the direction of price movement. During this correction stage, us as traders may look to exit our long position or even enter a short position in anticipation, right, of a potential reversal. And then finally, during this trend stage, we may look to hold on to our long position or enter additional long positions. I know that's a bit of mumbo jumbo, but as I said, it's identifying 3 different stages: impulse, correction, and trend. They're all working together, so it's going to give you opportunities to either stay in the trade, or the correction is going to give you that ability to say, actually, you know what, the impulse stage has not given me the setup that I now want in this correction stage, right? Because this is where price can retrace or consolidate before potentially moving in the same direction as the impulse stage. So if it doesn't give you that, it's going to give you the opportunity to hop out and then move in for a short. Or with it consolidating, it might give you better and tighter entries, because you might see a liquidity run. You might see some sort of money grab, which is, I guess, basically the same as liquidity run, into an imbalance and then start to correct itself in the way of whatever happened in the impulse stage. And then, of course, with the trend stage, that's when you're already going in it. You've done it. Everything's really good. It's moving in that direction of the impulse stage, right? So one of these benefits, as I was talking about, is that it provides a clear and systematic approach to trading. By identifying these different stages of price movement, you as a trader can make informed decisions about when to enter and exit trades. Impulse, you get in. Correction, you have the ability to hop out. Trend, it's going to tell you in no definitive term, well, in all definitive terms, I should say, whether you're in the right movement. So it's good if you're a bit of not a wishy-washy trader, but you like to hop in and out of trades. It's something that is good for you. And another benefit of this ICT trading is that it can help traders to manage their risk, which we know is really important. By entering and exiting trades at specific stages of price movement, right, you can limit your risk and potentially maximize profits. This is because by entering and exiting trades at specific stages, as I said, you could have a tighter stop loss here. You could hop in early at the move. You'll be able to hop out during the correction phase, for example, lowering that risk because you're going to be hopping out. And then if you decide to hop back in, you've got that tighter stop loss. You've got a bigger, therefore, take profit. Because whatever tight stop loss you have, you can either get really small take profit, or you can still go for the original one that you had in that impulse stage, right? And with that tighter stop loss, you're instead of getting 3%, you might get 4, 5, 6, something like that. So you can really maximize your profits, and it gives you the ability to hop out. Whereas any other sort of strategy, you really have to develop your own exit rules. Not saying that you don't have to do it here, but it's already built into the strategy. It's already giving you the opportunities and the know-how to hop in and out when in need be. Whereas when you make your own strategy, or you do breakout, you do X, Y, Z, you've really got to backtest so much to figure out, okay, here, what are my exit strategies? You'll be so surprised to find that many strategies out there do not have exit signals. Breakout strategies do not have exit signals. The majority of them don't. Not the ones that I've seen anyway, especially when I was learning. Wyckoff trading theory, that doesn't have any exit rules. It tells you when to hop in. There's really simple support and resistance. Again, tells you when to hop in. Doesn't tell you when to hop out. Really good of ICT trading there. However, of course, there are also some drawbacks to this type of trading. And one of the biggest drawbacks is that can be really difficult to accurately identify the different stages of price movement. This can lead to many missed opportunities or incorrect trade, which can result in significant losses. So there's one massive drawback here, guys. Unless you are, I wouldn't say a master of the strategy, but you've got the strategy down pat, you've done the back testing, you've put in the work, you understand it, then go ahead. But then I also would say, if you want to trade this, and don't come to me for this one, I'm finally not giving myself a plug here, don't come to me for that. Get yourself a mentor that does actually know ICT trading. I know there's people that have come to me and say, hey, do you trade impulses? And I go, nah, sorry, you're going to have to find someone else unless you want to trade price action, you want to trade breakouts, smart money concepts, I'm your guy. But this kind of thing, no. Because as he said, if you're not knowing it and you don't know how to identify these three stages, well, one, you're not going to identify which way the market's going properly in the impulse stage, which means two, your correction stage is going to be completely flawed, and three, you're never going to get to the trend stage in the first place. And even if you do get one right and you don't know about your corrections, you're therefore all of the advantages of ICT trading, poof, out the window, never going to work. Because you're not going to be able to identify when you can hop in and out of the market. If the correction stage comes around, it's saying, actually, Alex, get out of this trade, and you don't identify that properly, you're still thinking, hey, this might be impulse, then you can't maximize your profits and you can't minimize your risk, right? You can't be doing that. And it's therefore not a clear and systematic approach to trading. So you can't be making informed decisions. So even just by saying that, much like one of the other being a scalper, what we talked about, had really good advantages, but one massive drawback. Again, this is a huge drawback. You've really got to know your stuff. It is super punishing. And you could say, Alex, that's the same with all trading strategies. No, I don't believe so. There's definitely ones that will give you time, give you effort. It'll be less effort consuming in terms of one, learning it, and then two, when the market does decide to, turn away from you and start going the wrong direction can be a bit more forgiving, especially if you are entering that correction stage where it can consolidate, it can really shift down. That is known, as any of you would know if you have been trading for a long time, consolidation, big breakout moves. Big breakout moves. If you're hopping on the wrong end of a breakout move, you're going to get taken out really quickly. So you've really got to understand that to quite a large degree. I know I've been babbling on there quite a bit, but it is important that a lot of you guys get this down because I do know it's really, really popular. And just to add a little bit more variety in there, I guess another negative or a con about this strategy is that it is based on historical price data. And really, it may not be effective in all market conditions. Not to say it won't excel in quite a few, but if you are looking at, let's say, periods of high volatility, the stages of price movement can again be way more difficult to identify, and the strategy may not be as effective, especially because it is based on historical price data. And when it's really volatile, doesn't really mean that it's going with historical price data. So again, you can see a big pullback to there. It is a really popular trading strategy used within the Forex world. I know a lot of people do try it. It brings a lot of people in. And while it can provide a clear and systematic approach to trading, it can be very, very difficult to learn. And it will really punish you if you do not understand it. Great if you do. Awesome if you do. But if you're coming in here and you're looking for a beginner strategy, I would say there are a lot better ones out there. If you're an intermediate, you've got a challenge ahead of you. Even if you're 2 years in, I started to learn this, and because of the disadvantages that I've learned before, and I was more suited to trading something else. So yes, I understand that I may be biased here, but it wasn't for me, and I didn't really understand it. So I just moved away from it. Doesn't mean that you guys as traders can't benefit from it. Go out there, understand it. I know there's a lot of guys that love ICT trading out there, so I definitely don't want to bash it. It might just be me not being a skilled enough trader. Who knows? But I just didn't want to put it out there and just say, hey, as in all strategies, it's got its risks, it's got its advantages. I definitely, as a beginner, would say stay away from it. Intermediates, you're still going to have a challenge. If you're experienced in the markets, then go ahead. Try it. I think it would be really beneficial. And who knows, maybe later on, I'd go for it. All I know is that there's been quite a few ICT traders that have come to me, and their feedback when they learn my strategies, for example, is, oh, wow, this is so much more simple. Oh, wow, I'm not going to have to backtest as much, is a lot of what some of my students have been saying. So just going off them and my own personal opinion here, guys. Anyway, that is it for today. Again, my link to talk to me is in the description to this podcast, roadtoforex@gmail.com. Really simple. Until then, guys, have a great day, stay safe, and I'll speak to you in the next one.